$250,000 in taxes just triggered because you borrowed from your life insurance, and the IRS already sent the reclassification notice. You thought policy loans were tax-free. Your agent said so, but IRC Section 7702 has other ideas. If you own permanent life insurance, whole life, universal life, variable universal life, and you're thinking about tapping that cash value, this video will show you the exact corridor rule that converts safe borrowing into a six-figure tax recapture. By the end, you'll know the formula the IRS uses to reclassify your entire contract, what that costs you in real dollars, and what to check before your next loan. Let's start with the belief gap that gets most high-income earners trapped. You've been told life insurance policy loans work like home equity loans. You own the cash value. You borrow against it. The IRS doesn't care. You pay it back when you're ready, tax-free, because it's your money. That's the wrong belief, and it costs people $250,000 to learn the difference. Here's the correct reality. IRC Section 7702 defines what the IRS will allow as a life insurance contract. If you violate the 7-pay test or the corridor rules through cumulative policy loans and distributions, the entire contract gets reclassified as a Modified Endowment Contract, a MEC. And under IRC Section 72(e)(10), MEC loans aren't treated as tax-free borrowing anymore. They're treated as taxable distributions. When you take a loan from a MEC, it's taxable to the extent of gain in the contract. If your $500,000 policy has $300,000 in cash value and you borrowed $150,000, you're looking at ordinary income taxation on the gain portion, potentially $250,000 to $400,000 in taxable income, depending on your cost basis and how long the policy has been in force. At a 37% federal marginal rate plus state tax, call it 45% effective, that's $112,500 to $180,000 in actual tax liability, plus a 20% penalty under IRC Section 72(v) if you're under 59.5, plus interest and potential IRS audit exposure. The delta, you thought you were borrowing $150,000 of your own money. Instead, you owe $112,000 to $180,000 in taxes you didn't plan for. Now, here's where it gets worse. Most people don't discover they've violated MEC status until they file taxes the year they took the loan, or worse, years later when they try to surrender the policy and the insurance company recalculates the entire contract. So how does the IRS actually test whether your policy crosses the MEC line? There are two tests, the 7-pay test and the corridor test. The corridor test is the one that trips up policy loan borrowers. Here's the formula. At any point in time, the cash surrender value of your policy cannot exceed the net single premium required to fund the same death benefit at that insured's age and health status. Sound technical? It is, but here's the practical version. Every time you take a policy loan, you're reducing the cash value available to support the death benefit under the corridor. If cumulative loans push the remaining cash value outside the allowable corridor for that policy, boom, the contract is reclassified as a MEC retroactively. Insurance companies are supposed to test for this, but they don't always flag it proactively. And by the time you file taxes, the damage is done. Let me show you the real dollar example that most high-income earners miss. You own a $500,000 permanent life insurance policy. The cost basis is $50,000 in premiums paid over 15 years. The policy now has $300,000 in cash value. You decide you need liquidity, a business opportunity, real estate down payment, whatever. You're a high-income professional, so you're thinking tax efficient. Policy loan feels safe. You borrow $150,000. No immediate tax, but on the next policy illustration, or when you file your 2024 taxes, the insurance company or the IRS recalculates the corridor. Your loan violated the corridor threshold. The entire contract is now a MEC. Now, when you took that $150,000 loan, the IRS treats it as a distribution taxable to the extent of the gain. Your gain is $300,000 cash value minus $50,000 cost basis equals $250,000 in gain. Your loan is taxable up to that gain amount, so the entire $150,000 loan is taxable income at ordinary rates. At 37% federal plus state, $150,000 times 45% equals $67,500 in federal and state tax. But that's just the beginning. There's also the 20% MEC penalty under IRC Section 72(v). $150,000 times 20% equals $30,000 in penalty. Total tab, $97,500 in taxes and penalties on a $150,000 loan you thought was tax-free. And that doesn't include interest, amended return penalties, or IRS audit costs if they question the policy's original classification. So what should you do before your next policy loan? First, request a formal MEC status letter from your insurance company in writing. Ask them to confirm, based on the corridor test and all cumulative distributions to date, whether the policy is currently a MEC or whether a proposed loan would trigger MEC status. Get that in writing. Second, review Form 8853 on your last tax return. If you've ever reported a distribution from a life insurance contract, that form will show whether the IRS is tracking your policy. Third, consult a tax professional.